Karan and Arjun were childhood friends. Karan was well educated and holding a good job, but had plans to start a venture to sell fresh food to corporates online. For this, he needed capital, and banks and financial institutions charged too high a rate of interest. Arjun was an MBA and was earning a good salary. He has no intention to start a venture of his own, but he is looking to save his earnings in a medium where he can earn good interest and can withdraw whenever he needs money. Karan needed a seed capital of 8 lakhs for his business immediately. He couldn't afford to wait and accumulate the amount for seed funding. He was wedged in between private money lenders and banks for loans, but none offered him a good alternative, since both options would require him to put up an asset as collateral. These loans accrue hefty amounts of interest, which even surpass the principal. Furthermore, these loans are product-oriented in nature, so one cannot divert the funds of one loan towards something else. On the other hand, Arjun was also finding it difficult to find an all-in-one investment scheme which would allow him to preserve cash, get good returns, and withdraw money without any losses. No options were apt. Bank saving accounts offer very limited interest yield and have minimum balance and other withdrawal limitations. Fixed deposits have penalties on premature withdrawals. They also lock up money for a long tenure, thus costing the investors many opportunities. And mutual funds and shares are risky and unpredictable, with no guaranteed returns. They were all unpleasant choices. Since time immemorial, one financial instrument has always come to the rescue: chit funds. Chit funds are a unique combination of saving cum loan investment. That is, investors can save money in them and at the same time borrow anytime the need arises. Moreover, there is no interest charged on borrowing, and one can borrow whenever and for whatever purpose. In these, a group of contributors pool in a fixed sum of money every month, and through competitive bidding, each contributor gets to win the pot once. Karan and Arjun decided to invest in a government-approved, registered chit fund scheme. Their chit fund scheme included 40 members who had to contribute Rs 20,000 every month for 40 months, with the jackpot being worth 8 lakhs every month, which would go to one member via competitive bidding till all 40 members get to take the pot home once. Karan and Arjun contributed 20,000 rupees each in the first month. Since Karan needed funds urgently, he decided to participate in the bidding process in the first month itself. Karan decided to forego the maximum limit permitted of 25% and won the pot, thereby taking back the amount of 6 lakhs. From the remaining 2 lakhs that Karan had foregone, the foreman kept his fixed monthly commission, that is 5% of the chit value, and distributed the remaining 1.6 lakhs, that is the dividend, among all 40 members, thus reducing every member's obligatory monthly contributions. Karan used this amount to establish his restaurant. He couldn't bid for the remaining months, but he continued to contribute his share of 20,000 rupees minus the dividend every month. There arose no emergency for Arjun, so he patiently waited till the last month and got to take back the entire pot minus 5% foreman's commission. This way, Arjun earned an extra amount since he didn't have to forego any amount like others, and also earned healthy monthly dividends from amounts foregone by other bidders. This way, by investing in a registered chit fund, both Karan and Arjun overcame their financial dilemmas. Chit funds gave them freedom over the usage of funds, a lump sum of money for emergencies with no interest, handsome returns from dividends, and built in them the habit of savings. Karan gained competitive advantage and made profits by expanding his business from time to time. And Arjun reinvested the amount he got by lending at high interest rates. A chit fund is a good and most underrated financial tool in India. It's a